Most people think you need millions to retire early. But the truth? You can stop working forever with just 500K if you do this. Here's the problem. Most people spend their entire lives trading time for money, convinced they need at least $1 million to retire comfortably. But what if that's not true? What if 500,000 could be enough? If you know how to turn it into passive income streams that pay your bills forever. Without this strategy, most people will grind away for decades, chasing a number that might not even be necessary. In this video, I'll show you exactly how to turn 500K into multiple sources of passive income and how to structure it so you never have to work again. But first, let's talk about the biggest mistake most people make when they finally get their hands on 500K and how it can destroy their chances of financial freedom. Most people who come into $500,000, whether through savings, inheritance, or selling a business, make the same critical mistake. They treat it like a spending account, not an income-producing asset. They might buy a bigger house, upgrade their car, take expensive vacations, and before they realize it, the money starts to shrink faster than they ever expected. Here's the truth. If you treat 500K like a windfall to spend, it will disappear. But if you treat it like seed capital to generate passive income, it can provide for you, for life. But here's where smart investors do something radically different. Instead of asking, how much can I spend? They ask, how much can this money earn for me every single month without me lifting a finger? That shift in thinking changes everything. And now, let me show you exactly how to make that shift and set up your first passive income stream. So now that you understand the importance of the passive income mindset, let's dive deep into the blueprint. The 3 proven passive income streams that can transform your $500,000 into a sustainable, long-term source of financial freedom. These aren't get-rich-quick schemes. They're reliable strategies used by savvy investors around the world to build wealth and security. Let's explore each one in detail. 1. Dividend-paying stocks. Cash flow from ownership. Dividend-paying stocks are one of the simplest and most accessible ways to generate passive income. When you buy shares of a company that pays dividends, you're essentially getting a portion of the company's profits sent to you quarterly or monthly just for being a shareholder. Think about major companies like Coca-Cola, Procter & Gamble, or Johnson & Johnson. These are established businesses with decades of consistent dividend payments. Many of these companies are known as dividend aristocrats, firms that have not only paid but also increased their dividends for 25 consecutive years or more. Why is this important? Because it means your passive income has the potential to grow over time, keeping up with inflation and increasing your purchasing power. Let's break this down with some numbers. If you allocate $300,000 of your 500K portfolio into dividend-paying stocks that yield an average of 4% annually, you would generate $12,000 per year, or $1,000 per month, in pure passive income. If you find opportunities with a 5% yield, that income rises to $15,000 annually. But remember, higher yield often comes with higher risk. That's why it's critical to build a diversified portfolio across sectors, such as consumer goods, utilities, healthcare, and financial services, to reduce the risk of relying on any single company or industry. You can also simplify this by investing in dividend ETFs, such as Vanguard's Dividend Appreciation ETF, of VIG, or iShares. Select Dividend ETF, DVY, which spread your investment across dozens or hundreds of dividend-paying companies, automatically diversifying your exposure. Another pro tip, consider using dividend reinvestment plans, DRIPs, which automatically reinvest your dividend payments to buy more shares. Over time, this compounds your investment, creating a snowball effect that accelerates your wealth and passive income generation. But dividends alone may not be enough to cover all your living expenses. That's why we turn to the second pillar of your passive income strategy. 2. Real estate rentals. Building tangible wealth. Real estate has long been considered one of the most stable and reliable ways to generate passive income. Unlike stocks, which exist in the digital realm, real estate provides you with tangible assets, properties you can see, touch, and control. With $500,000, you have multiple options in the real estate space, depending on your risk tolerance, location, and personal preferences. Here are a few strategies. Option 1. Buy and hold long-term rentals. You could purchase one or more single-family homes or multifamily units in markets with strong rental demand. For example, in certain Midwestern or Southern U.S. cities, you can buy a quality rental property for $150,000 to $250,000. With $500K, that means you could potentially purchase 2 or 3 properties outright, avoiding mortgage debt altogether. Let's assume you buy 2 properties, each generating $1,800 a month in gross rent. After accounting for property taxes, insurance, maintenance, and setting aside a vacancy reserve, your net income might be around $1,200 per property per month, or $2,400 total. That's $2,800 per year in passive income, not to mention potential property appreciation over time. Option 2. Leverage financing. Alternatively, you could use leverage, financing part of your purchases with mortgages, to acquire more properties with the same $500K. For example, if you make 20% down payments, you could control $2.5 million worth of real estate. Of course, leverage introduces risk, especially if the market declines or if you experience extended vacancies. But it can also significantly amplify your passive income and wealth-building potential. Option 3. Short-term rentals. Another option is investing in short-term rental properties through platforms like Airbnb or Vrbo. Short-term rentals often generate higher cash flow than traditional long-term leases, but they also require more active management or the use of property management services. Let's say you buy a vacation property in a desirable area. If you can rent it for $150 per night and achieve an occupancy rate of 70%, that's over $3,000 per month in gross income. After expenses, you might net around $2,000 monthly from a single property. Other real estate options. Real estate investment trusts, REITs. If you want exposure to real estate without the hassle of direct property ownership, you can invest in publicly traded REITs that pay out 90% of their taxable income as dividends to shareholders. Some REITs specialize in commercial properties, apartment complexes, healthcare facilities, or data centers, offering you diversification within real estate. REITs typically offer yields between 3% and 7%, depending on the type and risk profile. By allocating, say, $100,000 into a diversified REIT portfolio with a 5% yield, you could generate $5,000 per year, or about $416 per month, in passive income. Real estate offers you not just cash flow, but also powerful tax advantages through depreciation, mortgage interest deductions, and capital gains treatment. But as with any investment, it requires due diligence and risk management. Now, let's move to the third pillar of your passive income blueprint. 3. High-yield bonds and fixed income investments. Stability and predictability. While stocks and real estate can offer higher returns, they also come with market volatility. That's where fixed income investments like high-yield bonds or bond ETFs play a crucial role in providing stability to your portfolio. High-yield bonds, often known as junk bonds, are issued by companies with lower credit ratings, but they compensate investors with higher interest payments, sometimes in the range of 5% to 8% annually. Let's say you allocate $100,000 into a portfolio of high-yield bonds yielding 6%. That's an additional $6,000 per year, or $500 per month, in predictable income. Alternatively, you can invest in bond-focused ETFs, like the iShares iBox Dollar High-Yield Corporate Bond ETF, HYG, or the SPDR Bloomberg Barclays High Yield Bond ETF, JNK, which diversify your bond exposure across hundreds of issuers, reducing default risk. For those seeking even greater safety, consider investment-grade corporate bonds or municipal bonds. While these offer lower yields, typically 2% to 4%, they come with lower default risk and may offer tax advantages, especially in the case of municipal bonds, which are often federal and state tax exempt. Moreover, Treasury inflation-protected securities, TIPS, can be an excellent hedge against inflation, ensuring your passive income retains its purchasing power over time. By strategically allocating your $500,000 across these 3 pillars, dividend stocks for growth and cash flow, real estate for tangible assets and income, fixed income for stability and predictability, you create a robust, diversified passive income portfolio capable of supporting your lifestyle while protecting your capital. But remember, the key isn't just in choosing the right investments, but in setting them up to work together, maximizing synergy and minimizing risk. Next, let's explore how to protect and grow these income streams over the long term. Building passive income is just the first step. The real secret is knowing how to protect it and make it last. First, always diversify. Never put all your 500K into one investment. That's a recipe for disaster. Split it across different assets, so if one underperforms, the others keep you afloat. Second, guard against inflation. Your money today won't have the same buying power in 10 or 20 years. Invest in assets that appreciate or adjust with inflation, like real estate and stocks. Third, consider reinvesting a portion of your passive income. By reinvesting dividends, rental profits, or bond interest, you can create a snowball effect, growing your income over time, even after you've stopped working. Finally, maintain the right mindset. Passive income requires patience, discipline, and long-term thinking. This is what separates those who achieve financial independence from those who risk losing it all through impatience or poor decisions. Now, let's wrap this up with the key takeaways and your next steps. So here's what we've learned. With $500,000, you don't need to work another day in your life if you structure it properly. By building multiple passive income streams, safeguarding your portfolio, and thinking long-term, you can achieve what most people only dream of: financial freedom and control over your time. If you found this valuable, make sure to subscribe for more strategies on building passive income and wealth. And check out the next video on the biggest passive income mistakes that could cost you everything. You don't want to miss it.